Hello, everyone. This is Joe Zappi, a partner at LVW Advisors, and I'm here today with the founder and CEO, Lori Van Duzen, and we'd like to report to you today on the state of the markets, April 2023. Hello, Lori.
Hi, Joe.
This should be a fun conversation.
Yeah.
So before we get started, just have to go through a couple of compliance things, like just to remind everybody that anything we talk about today shouldn't be considered investment advice, and any of the comments made should also not be considered recommendations or may not exist in LVW client portfolios. So with that behind us, let's talk a little bit about where we are so far this year. 2023 is off to a decent start. And it's great news after 2022 was such an awful year for both stocks and bonds.
Yeah, it's interesting. So there was an article in the Wall Street Journal, I think on Friday, about the 60-40 mix being back. But what's really happening here is we have had some easing of price pressures. We've had some of the Treasury volatility retreat. We've had the US dollar decline. I think it's at a year low. All of these things have kind of kicked up a little bit of risk appetite, a little bit. What's interesting though is, you get beneath the surface of, at least if you look at US large cap, for example, and a lot of the gains have been a mega cap rally. You have Amazon, Microsoft, Apple, mostly Apple and Microsoft kind of leading the charge. When you strip that all out, you've got a lot of things moving sideways, and sectors, individual names have had big swings underneath the surface. So there has been a lot of volatility, and I don't think these numbers actually speak to what's really happened, but it is more constructive.
Yeah, for sure. And it's also good to see that the bond market is acting better after the worst year in history. So when you and I were preparing for this video, we went through a couple of things, but I think that it makes sense to talk a little bit about the Federal Reserve and the current interest rate cycle that we're in now. Let's say compared to the last time that the Fed really raised rates aggressively, which of course is back in the early 1980s, when Paul Volcker was in Jerome Powell's shoes. And I think it's pretty interesting that today there's so many Fed governors out there giving talks. There's press conferences after the Fed meets. They release the minutes. They've got their dot plot. And I guess what my takeaway is, and I'm curious what you think, but what my takeaway is that we really probably should pay attention to the Fed because they're being incredibly transparent about what they're doing. And the markets are trying to anticipate the next move. And I'm just not really sure that we need to do that. I think we can just listen to what the Fed's saying and assume what they're saying is true. What are your thoughts?
Yes and no. I don't know. I think Mohammed Al-Arian had a really good point that the Fed should talk less and they should say things that are more meaningful. So it seems like, for example, in the UK, they focus on things like the dot plots and the things that are really important. It's a false choice. I think he said that to say, we should go back to the way the Fed was before, but they're really talking a lot and not everything they say is super meaningful. So I think we have to stick with kind of looking at the facts and be truly data dependent. And there's a lot of mixed signals in this economy.
Yeah, no question.
Yeah.
Sorry.
I would just say that slide says they're behind the curve again. They're really behind the curve, but I don't think anyone would argue with the fact that they missed it, that they were 9 months behind, that they were providing liquidity when inflation was at 7.5%, and now they're playing catch up.
Yeah, I was just going to say, so contrary to my comment and actually in agreement with your comment is this chart. Let me explain it. So the market doesn't really believe what the Fed is saying. And 1 year ago today, the Fed interest rate was at 0.75% and the 2-year Treasury was already at 2.4. So the 2 year has always been a great indicator of where the Fed should be. And today, the blue line, of course, is the 2 year Treasury. And today, the 2 year Treasury is around 3.9 and the Fed's at 5%. So a year ago, the 2 year Treasury was saying, you're way behind the curve. You need to raise interest rates faster. And today the market is telling the Fed, you've raised enough, and it's time to either stop raising or maybe even potentially start cutting rates.
But I think there's only one Fed governor that said they should not go ahead with 25 basis points in May. So most likely, it's what happens from there. And when you're this behind the curve, how long will they stay where they are? There's been more damage done than I think people realize, and most likely they're going to have to stay where they are for longer.
Right.
But you're right, inflation is moderating.
Yeah, no,
That's for
inflation is
sure.
moderating. The problem is the white line, and this is actually pretty recent. This is through last week. So this is the most recent CPI report. Sticky inflation still running at like, over 5%. And it's going to, it will be hard to get that inflation down. And we're nowhere near the Fed target of 2%. So the idea that they
But
get to
it's
5. Oh,
yeah. Sorry to interrupt you. I just think this is interesting too, because if you look at this a lot of different ways and you strip out shelter, CPI deflated month over month in March, and it's either declined or flattened in 3 of the past 5 months. So this is a really tough read in
right.
terms of where inflation actually is.
But this is exactly what, in Powell's speech in August at Jackson Hole, this is exactly what he said. Expect pain. It's going to be a long, slow process. We expect inflation to moderate, but it's going to take a while, and we may end up putting the economy in recession. So, these are all things that they've said, and it seems to me, anyways, that it's starting to play out a little bit. So the next slide is the yield curve and where it is relative short-term rates and long-term rates. And Powell actually talked about in August, he talked about the idea that he really doesn't pay much attention to the 2-year, 10-year yield curve inversion. He really likes to look at short-term rates, which would be the 3-month Treasury and the 10-year. And that's what this is. And so the blue line here shows you that the yield curve is the most inverted that it's been at any point since World War II. And that means that policy is extremely restrictive at the short end of the bond market. And historically, what this has done is it makes it very difficult for banks to loan money. It makes it very difficult for small businesses to get loans, and it generally slows down the economy. So the Fed is, I would argue, they're in a restrictive position right now.
Yeah, and the inverted yield curve only happens like something like 15% of the time. A normal 2-10 curve is something like 120 basis points. So the question is, it is restrictive, and how do we end up normalizing? And that's really the question people are trying to solve for.
Yeah, when that curve uninverts, right? So when anytime the 3-month 10-year has been inverted, every single time a recession is followed. So this indicator is perfect in terms of.
It's a pretty solid indicator.
Yeah. And then let's just go through a couple of other things quickly here. So money supply, which is just how much cash is in the system. Is it growing? Is it shrinking? And so right now, money supply year over year change is negative. And it's the first time in history, again, since post-World War II, that money supply has been negative year over year. The only thing I would add is I'm not sure how much we can really rely on this particular data, because we also saw a 20% increase in money supply because of the actions that the government took around COVID, which you can see on this chart.
Yeah, it is a measure of liquidity that's important, and it did contract in February, and it's declined now for 7 months in a row. So it's pretty unprecedented.
It is, and it just speaks to, again, the Fed kind of following through, at least to me, on the things that they said they were going to do. And when money leaves the system, it's difficult to be super constructive on most risk assets, right? So the next chart is just the leading economic indicators, which again have been pretty reliable in terms of showing when the economy is near or in recession. And the leading economic indicators in its most recent reading is signaling a recession sometime in the next few months. I don't know what your thoughts are.
Yeah, no, I think you know my thoughts, but I think we're in a period where if we're not in recession, we're heading into one. And I think it's just a lot of messiness around the labor market. It's a tough read, but if you look at everything, it's pretty much slowing down.
Yeah.
Except for this, the
Yep.
unemployment rate. Um, and I think there's cracks that are clearly surfacing in the labor market. And remember that claims are a leading indicator, unlike the unemployment rate, which is a lagging indicator. So I feel like we're looking at lagging stuff here. And that was one of the points I think that Mohammed El-Arian made the other day in something I was listening to, I think on Bloomberg. And you really have to unpack this stuff. And if you look at, cracks in terms of the labor market, layoffs, things are definitely nudging up. So again, unemployment lagging indicator.
Yeah, no question. And we were talking about this before as well, and that is that unemployment tends to spike, and it tends to spike pretty quickly because there becomes a cascade effect, almost like a, a boulder rolling downhill. It begins to gain speed as larger companies make layoffs, then their suppliers make layoffs, and the suppliers of the suppliers make layoffs, et cetera. And so we could see a spike in the unemployment rate happen pretty quickly, although it hasn't happened yet, to your point about conflicting
Mhm.
evidence.
Mhm.
So let's just take a look at the next slide. I'm just going to quote you, and I don't know if you said that the Fed raises rates until they break something. That's historically been their track record. Not a very good one, but it appears to many that things are starting to break with liquidity leaving the system and money supply negative, the economy turning towards recession. But maybe the one thing that's starting to break is what's going on in the banking system.
Yeah, I mean, I think like I feel like everyone's saying this has this phrase now. The Fed, raises rates till something breaks. But if you look at bank credit, if you look at real estate loans, if you look at commercial real estate loans, if you look at the small business economic trends data, if you look at all of it, banks' willingness to lend to consumers kind of has fallen off a cliff, really.
It has.
So
It,
credit
it,
availability from a year ago is very, very different. And just ask any business person, ask anybody trying to get a mortgage. It's a problem.
and to your point, I think you knew this slide was coming, so you talked about it a little bit.
I
We,
forgot,
we've had
but
we've
yeah,
had a
great.
couple high profile bank failures, Signature Bank and obviously Silicon Valley Bank over the past 30 days. They failed. And so now what's being brought into the spotlight is that small banks are really, really important to the economy, maybe more so than people realize, because small banks make up the majority of commercial real estate loans, the majority of residential mortgages, about half of all commercial and industrial loans, and they also are almost half of consumer loans. And if
Yep.
small banks have pressure on their equity ratios and they have pressure on their deposits, as we're seeing now, they will tighten up, and they will stop lending, or at least slow their lending.
Yeah, now, remember that these banks, outside of the mega banks, these banks are responsible for kind of what makes the economy tick: small, mid-sized business loans, a lot of real estate loans. And, the Fed can continue to, protect depositors, but they cannot force these banks to lend. And that's really an issue. For now, we're in a phase where these banks are, going to be focused on shoring up their balance sheets.
That's right.
And so, yeah,
Yeah,
yeah, it's
absolutely. And so it's already having its impact. This next slide is just a continuation of the last one. This is from Apollo, and it's great. And it just says, bank lending is already rolling over after Silicon Valley Bank failure. It turned down pretty decisively.
yeah, and I would say, a couple of things about that. These were, I think, idiosyncratic bank failures. that, the saying that the tide goes out, you see who's swimming naked. This particular case, SVB, was obviously a poorly run bank. The banking system generally is and was in good shape. Now we just have this epic problem of credit conditions tightening. And I'm not sure how that's all going to get fixed here, because we absolutely need the regional banking system, and the vast majority of banks are very well run. So
Yeah,
this is a piece of it.
yeah,
Yeah.
there's probably no bank in existence that could, if every depositor requested their funds on the same day, that they could produce it, because the very nature of the banking business is to take in short-term deposit to make long-term loans. And the only other comment I would have about this before we shift back to the stock market and valuations is that if the majority of loans that are made by the small and regional banks, and small businesses account for about 70% of the employment in this country, you can start to connect the dots to see that we really need small businesses to be able to access credit in order for them to continue to expand and keep their employees. So when you start to put all these things together and connect dots, it seems pretty obvious to me that the economy is going to slow faster
Right.
than it has
I,
anyway.
yeah, I agree.
All right, well, let's shift gears for a second and just talk about the market. So in spite of all these things, the stock market just continues to really hold up. As we showed you on the first slide, the S&P was up something like, I don't know, 7 or 8% in the first quarter. And right now it's up about 8% for the year through Friday. The NASDAQ's up almost 15, but the market still isn't cheap. Lori, what gives here? What do you think?
Yeah, no, it's not. I think this is all about, going forward. Earnings season started on Friday. It is all about earnings and where interest rates settle out here, Joe. And and I know that stocks lead out of recessions, and we're not forecasting or forecasters, but it never really pays to be too bearish. But this is not a cheap market. However, as we pointed out earlier, on the surface, it's being driven by some mega stocks. So I think if you go underneath the surface, there's plenty of opportunity, but I think you have to know what you own in this kind of market. And if we are in recession, those companies that are in good shape, balance sheet wise, good competitive positions, it's a winners and losers market. So it is all about earnings, which are declining.
Yeah, so this chart here shows analyst estimates of earnings, and analysts are expecting this quarter, the earnings season that started on Friday, to be the trough earnings for this particular cycle, with earnings again negative in the second quarter and then shifting to positive in Q3, and actually the S&P 500 getting to the point of having record quarterly earnings by the end of this year. And clearly the economic data doesn't point to an expansion of earnings, so it will be really interesting to see if analyst estimates come down further, or if the economy is actually able to continue to expand and we're able to avert a recession.
Yeah, I don't know, because I just saw this data from B of A that the 2023 consensus earnings forecast for the S&P 500 has been sliced about 13% since June of last year. And so momentum is kind of squarely to the downside. And the pace of revisions is pretty steep. So I I think, this is a reason to be cautious here at these valuations and what we see happening with earnings.
Agree. So one of the other questions that we get a lot is, how do you figure out, when to buy? How do you figure out when the market bottoms? It's an impossible thing to know until the bottoms actually occurred. And, one of the things we said in our last webinar was that our working thesis, at least at that point, was that October 2022 probably was the low for this cycle, because markets anticipate, as you said, what happens after a recession, and that's typically an expansion. The one point I would make is that, and this is from Tony Dwyer, and it's great, is if October was the low, then 6 months later, this is the weakest bounce or rebound off the low at any point going back about 50 or 60 years. So, time will tell. But either way,
Mhm.
it hasn't been a typical robust rebound off the bottom, if in fact October was the bottom. So let's talk a little bit about how markets perform around recessions. And this chart from Goldman Sachs is pretty good, but basically it says peak to trough. The S&P, there's been 12 recessions since World War II. Peak to trough, the market on average drops about 24%. Or I should say that's the median. And from the all-time high in January of 2022, which is crazy that it's 15 or 16 months ago already, to the October low, I think was about a 28% drawdown. So, we could draw the conclusion that, price declines around recessions, we're right about at the median, and it is still pretty possible that October low number will in fact be the lows. I think the big question is, do we go back and test those lows, or is it just clear sailing from here?
Yeah, I guess we go back to it's all about, earnings, interest rates, what happens, kind of in this economy, what kind of recession this is. So it's really somewhat of a conundrum. I don't think that any of us know if we'll go back and retest the October low, but I think what we're pretty convinced of is if there's a moderate recession coming or worse, that is absolutely not priced into this market.
Certainly something worse than moderate for sure. At least
Yeah.
that's how I feel. So let's talk a little bit about valuations. Valuations around the world. There's a lot on this chart, and I'll just take a second to explain it. This shows the U.S. markets, Japan, Europe, emerging markets, and China. The purple band shows the 25-year average valuation as measured by PE ratios. And this just reiterates the fact that while the US market is not as expensive as it was at its peak in 2021, it still sits above its 25-year average. But as we've been talking about, and as we've actually been positioning in portfolios, the developed markets outside the United States are much cheaper on a pure valuation basis.
Yeah, and having the US dollar decline is a tailwind for markets outside of the US. So I think that's something to really keep in mind in addition to the valuations being more compelling.
For sure. I mean, I think you have to ask yourself the question: how much of the move in non-U.S. markets, in the past few months, is a result of the dollar? I think it's kind of a case of the chicken and the egg, but the dollar is definitely a good indicator.
Yeah, and I think we said on our last podcast that we were constructive on some of the markets outside of the US, and they've certainly performed better, and we continue to be fairly constructive.
Yeah. So let's just shift for a second and talk a little bit about maybe a couple of contrarian indicators. You and I are both value investors. We believe strongly in mean reversion, that assets do revert back to historical valuations or they snap back. And we also like to look at contrarian indicators. So I think this is a bullish contrarian indicator. And what we're showing here is right now there's a record where there's over $5 trillion in money market funds. And that's the highest level by a lot than any point on this chart, which goes all the way back before the great financial crisis. And I think the takeaway, at least for me, is that investors are pretty bearishly positioned in the sense that they've got a lot of money in cash. It makes sense. They can get paid 4 to 5% on that cash. I think it also speaks to why there's some issues in the banking system, but it won't take a lot in the way of the news either not getting much worse or actually getting a little bit better for this money to move back into risk assets.
It's a good point. I think the takeaway of what we've talked about so far, it sounds a little negative. It's cautious, but there are some things, contrarian indicators that say, okay, when things stabilize or turn around, this is why you don't time markets.
That's right.
You rebalance, you're constructive around things. If we've said this before, if we were to retest October lows, we would do what we always do. We would rebalance back.
Right. Sorry, I'm clicking through here a little bit with a fat finger. So professional investors are also super defensive. Bank of America does a global fund manager survey. They do this every single month. In the most recent survey that came out, cash as a percentage of an allocation is the most overweight position of all of the managers that are surveyed in the Bank of America survey. And we do watch this because when positioning gets skewed too far in one direction, it really makes sense to take that contrarian viewpoint, or at least challenge yourself as to why. And you can see that managers are most underweight US equities right now, in spite of the market having moved higher, and most overweight in cash. Again, I think this is a bullish contrarian indicator.
Mhm. Yeah.
You know, this is, I think, one of the last slides we're going to share today, and this is an interesting chart that goes all the way back to the 1800s. And the blue line is earnings, and as it relates to stock prices, and you can see that there's a pretty significant trend there, and that is, at the end of the day, stock prices follow earnings. There may be lots of volatility along the way. The average peak to trough every single year in the S&P 500 is around 14% a year. But yet over that same measured period, stocks on average increase roughly 10% a year. And this is why, right? Stocks follow earnings over time.
Mhm. It's a pretty chart, Joe.
Thanks.
Yeah, I really like it.
Well, we'll thank
But
Fidelity for this one.
yeah, thanks, Kelly.
So let's wrap it up. Lori, you want to walk us through our
Sure.
final thoughts?
We're likely in a recession. Yeah. I mean, while it is technically not a recession, I just did an interview the other day, and I said that, we haven't had 2 consecutive quarters of negative growth, which has always been the kind of definition. But this is a little bit different. Underneath the surface, a lot of slowing down. We've had the fastest rate hike cycle in history. A lot of the indicators that are being looked at are not leading indicators; they're lagging. So, but to your point, that the pretty slide earlier, stocks lead out of a recession. So while we're not overly bearish, we're certainly not bullish here, and we believe stock picking is important. We believe the index is being concentrated, at least in the United States, by 2 stocks. So I'm not a big proponent of indexing right here, Joe, and I don't think you are either. I think it's back to basics. It's understanding companies in competitive positions with strong balance sheets that actually get stronger in recessions. And this is my opinion. I think you agree with all the credit conditions tightening, even before the regional banking issues and SVB, companies were approaching our investors in credit to restructure loans. It's just going to be a very big opportunity, I think, to be a provider of liquidity. We talked a little bit about that on the last podcast, but it's probably one of the biggest conviction ideas we have is the private credit side of things, because the banking system is not going to be providing these loans. We've talked about how these lending conditions have contracted so much. So somebody's got to pick up the slack. And I think there's just this huge opportunity that's here in private credit. So we are talking to our clients about this, and we're happy to talk to whomever is listening about some of our ideas and how we're putting money to work here.
That's great. That's great. I guess I would just really summed up well. I think I would just add a couple of comments, and that is, under the stick to basics tab, for the first time in a long time, cash is earning over 4%. Bonds entered the year with much more attractive yields, and what we mean by stick to the basics is just that. Own equities that are reasonably priced, and don't be too concerned about holding some cash and some fixed income. And there will be opportunities that come along where that cash can be put to work when it seems like we are past this rate hike cycle. And I do totally agree with you in terms of what's going on in the banking system will lead to opportunities for those that are providers of liquidity or provide rescue capital to businesses that can't get money from banks. So I guess that wraps it up. We did it all in 30 minutes. I think that this was a really good webinar, but we'd love We love everybody's feedback, and feel free to reach out to anybody on the LVW team with questions. We're recording this on Sunday, April 16th at around 12 noon. And Lori, I want to just say thank you for taking the time to talk with me about all of these things, and I hope you enjoy the rest of your weekend.
You too, Joe. And yes, I just would reiterate, reach out to us. We're happy to provide more specifics, which we can't do as much of as we would like in these kinds of recordings. But we do think there are some really interesting opportunities, and happy to talk to anyone who would like to contact us.
Thanks so much.
Thank you.